Hello, good evening. My name is Juan Castañeda. I'm the director of the Institute of International Monetary Research, and it's a pleasure for me to welcome you to a 2017 public lecture of the Institute, this year given by Martin Taylor, member of the Financial Policy Committee of the Bank of England. But I will leave my colleague, Tim Condon, the chairman of the Institute, to introduce you properly to our speaker. But before that, may I just tell you a little bit more about the Institute, what we do, and rather than me telling you with my peculiar Spanish accent, we thought that it was better to play a proper video with proper English. So if I can just ask you for your attention just for a few minutes.
Welcome to the Institute of International Monetary Research, Public Lecture 2017. So who are the Institute of International Monetary Research? The Institute of International Monetary Research has been established in association with the University of Buckingham. One of the main purposes of the Institute is to promote research into how developments in banking and finance affect the economy as a whole. The Institute's wider aims are to enhance economic knowledge and understanding and to seek price stability, steady economic growth and high employment. As a distinctive feature, we pay particular attention to the effect of changes in the quantity of money on inflation and deflation and on boom and bust cycles. The Institute is an educational charity. You may wish to visit our website to learn more about the Institute's research agenda, or take a look at our latest publications, or register for any of our upcoming events. You can also view one of our many videos on subjects such as the Great Recession and debunking the myth. So here are some of the things we do. Recently, in collaboration with the University of Buckingham, we have launched a new master's programme, Money, Banking and Central Banking. This is a 1-year, full-time master's programme, but it can also be taken over 2 years as part-time study. We also provide professional courses on money and central banking, recently to delegates from the National Bank of Angola, who came to Buckingham. We provide monthly monetary updates, a series of notes analysing the latest monetary trends in the world's largest economies. We also email out our newsletter, which gives you links to all of our research and our news. Please donate to the Institute of International Monetary Research. It doesn't matter as to the value of your gift, but the giving of your gift does matter. Thank you. You can also follow us on social media. You can find us on Facebook, on Twitter, and on LinkedIn.
Well, thank you very much for your attention. As you can see, what we do is pretty much specialized in money banking and central banking, and it's quite unique, may I say. Not many do what we do, or we want to think, and we are very small. We run on just on donations, so we welcome your support. And indeed, let me thank Martin Taylor for being here today and collaborating with us. So with any further delay, may I just introduce you to the chairman of the Institute, Tim Condon, who will be giving a proper introduction to our speaker. Please, Tim. All yours.
Well, good evening, everyone. Thank you very much for coming, and thank you very much, Martin, for accepting our invitation to give this lecture. I first met Martin Taylor, it must have been in 1970 and 1980, when Martin was a journalist working with the Financial Times, editing the Lex column. And I was working in the city for a stockbroking firm called L. Mercer & Co., writing a green weekly monster, which was telling the world about the money supply and banking. And Martin very kindly told me at a meeting of the Political Economy Club about 2 years ago that it was in reading my notes that he really first came to understand what banking was all about. So I thought that I had then to respond to this by retaliating, by inviting him to come and talk to us, and that's what we're doing this evening. So there we are. Now I have to confess I was a little bit puzzled when we got the title of this evening's lecture, the Committee of Public Safety. In the early 1980s, there were many debates between the Keynesians and the monetarists which roll on. And if you felt excited or bitter or angry about these debates, you sent a letter to the FT, which of course Martin used to work, and other places too, like letters to the Times and so on. Well, the Committee of Public Safety was set up, I think, in April 1793. And it was, in fact, the effective executive government of France in the Reign of Terror. And they had differences of view in the French Revolution. I think there was something called the Herbetists and the Dantonists. I did my homework, you see. And they didn't send letters to the FT, they sent them to the guillotine if they didn't like them. So I don't quite know, Martin, what you're proposing this evening, but thank you very much for giving us the lecture this evening. I'm looking forward to your talk. Can I just say that Martin will be giving the talk itself, and there'll be Q&A afterwards. So if you're feeling angry, bitter, whatever about the system of financial regulation we now have, you can ask questions, and there may be some answers, but these answers will be under Chatham House rules, and they won't be recorded. So if you see the film stopping, it's not because they don't want to see you performing on. It's just simply that the talk itself is on public record, but the Q&A is under Chatham House rules. Thank you very much, and Martin, thank you again very much for coming to talk to us. Thank you.
Thank you, Tim, and thank you, Juan. Juan, I find your Spanish accent absolutely charming. It is a great pleasure to speak at a meeting organised by the Institute this evening. As Tim has told you, it's nearly 40 years since I first came across him, and that was about the time that I made the acquaintance of another great British institution, the Bank of England. Now, at that time, the bank was engaged on behalf of the Thatcher government in an attempt at once elaborate and quixotic, it was eventually abandoned, to control the growth of commercial bank balance sheets through a mechanism popularly known as the corset. Charles, you remember it very well. Rival schools of thought poured forth interpretations of the arcane data on interest-bearing and indeed non-interest-bearing eligible liabilities that for a few crazy months mesmerized financial commentators and provided harmless fun for those of us who were journalists. Tim's analysis was thorough and brilliant, and his conclusions were clear, and even then he was developing the knack of being inconveniently right. Now I sit on one of the bank's policy committees, the Financial Policy Committee, the FPC, charged with safeguarding financial stability. In another echo of stirring historical events, even more dramatic than the loosening of the old lady's corset, I like to think of us as the Committee of Public Safety, the COPS if you prefer. We need to frame our objectives audaciously. This is the group that might, no, that would have prevented the worst of the financial crisis if only it had been created in time. Now, as Tim has told you, the original Committee of Public Safety had been formed in Paris in April 1793, exactly 220 years before the FPC, and at the height of a rather different revolution, to protect France from foreign enemies and internal sedition, in short, from instability. Now, the Paris Committee, la Comité du Salut Public, soon assumed what might be described as sweeping powers. Roughly the same size as the modern FPC. It was enlarged from 9 members to 12. You know, these bodies never get any smaller. At about the time that Robespierre joined, bringing his trademark concentration and drive to the group's affairs. Now, perhaps because it was not answerable to Parliament. I mean, the revolutionaries could hardly have been expected to get everything right at once. It rather overreached itself, approving at one significant policy meeting an idea, presumably put forward by a junior staff member, that all crimes should be punished by death. And it was then that, as Tim has told you, the terror followed. And the committee, which took an admirably robust line on conflicts of interest, ended up guillotining half a dozen of its own members, as well as nearly everybody else. Though in some ways perhaps not an ideal model, the Committee of Public Safety showed in its short life 2 hectic years from foundation to collapse that policy committees can make a difference. It also showed the danger of going too far, of working in fact against the public interest. The FPC, in its almost 5 years of existence, or more like 7 if you count, as I'm very much inclined to, its 2 years as a pre-statutory body, may have been more circumspect than its Parisian forerunner, but has nevertheless shown its determination to use macroprudential policy tools in a disciplined and effective manner. A remark made by Claudio Borio a few years ago lingers in my mind. He urged macro-pru policymakers to act with ambition and humility. I hope and feel that that captures the way the FPC has behaved so far. We've both talked a little about the original Committee of Public Safety. Let me now give you an account of what the modern FPC is doing. I want to structure my remarks around 3 areas. First, how do we aim to keep the public safe? Second, how do we ensure that we behave in a measured way, respond to criticism, and therefore have the consent of the public that we serve? Thus, I hope, avoiding the executions that quite literally expunged the historical committee. Finally, I want to delve into the workings of the FPC and explain how, through vigorous yet consensus-seeking debate, we aim to be both ambitious and humble. Your conference tomorrow, Tim, as I understand it addresses the question, has financial regulation gone too far? Now, it's certainly worth considering, but I hope you won't mind my pointing out that it does not belong to the set of unasked questions. Bankers have been asking it every day for the last 7 or 8 years. It is perhaps a shame that few, if any, conferences were held in the years before the crisis, at the end of the Ancien Régime, so to speak, to consider the question, is financial regulation too feeble? Believe me, it was. I think a fundamental asymmetry explains both the weak regulatory framework before the crisis and the re-emerging debate on capital. Outside periods of financial crises, bank regulation benefits, to an almost imperceptible degree, a very large number of people who know next to nothing about it. In a crisis, of course, the benefits become clear. It inconveniences, to a more significant degree, a relatively small number of people who take an intense interest in it. Some of those who consider themselves inconvenienced hold conferences and organize lobby groups. The inconvenience is immediate, while the benefits are diffuse, and they show up so slowly as to be almost undetectable. Just halving the frequency and amplitude of financial crises, very difficult to prove in the short run, would represent, of course, a huge economic gain. It is salutary to remind ourselves of what things were like a mere 11 years ago. In 2006 or thereabouts, a poll by the Centre for the Study of Financial Innovation found that bankers were already putting regulation at the top of the list of things that annoyed them, even though at the time there was no regulation to speak of. RBS, for example, ran a trading book of £470 billion, supported by equity capital of 2.3 billion, leverage of over 200 times. Rather sporting, I think you'll agree. In the end, the losses on these activities in the crisis were more than 5 times higher than the equity that was meant to absorb them. But undercapitalization was a feature of the system. It wasn't an RBS-sized glitch. The FSA estimated that losses on investment bank activities of major international banks during the crisis, at an astonishing $240 billion, were 60% higher than their total capital. Nearly a quarter of these losses were so-called credit valuation adjustments, the losses due to downgrading the creditworthiness of a counterparty which weren't capitalized at all under the pre-crisis framework. Instruments that were designed to be loss-absorbing, giving the illusion of respectability to bank capital levels, turned out to be largely homeopathic in nature, alternative capital indeed. Even what was regarded as the most potent type of capital at the time, so-called Tier 1, gave an inflated view of bank solvency. RBS reported what they called a strong Tier 1 capital ratio of 7.3% in 2007. Subsequent estimates based on the new Basel III gold standard suggest they've been running their business on a risk-weighted ratio of barely 2%. Let me give a different kind of example. In the report on the failure of HBOS, we may read that the FSA, at that time the banking supervisor, was worried about some aspect of HBOS's business and proposed to subject the firm to a stress test. The firm's reaction was to commission consultants to argue that the scenario in the stress test was unreasonable and that it should therefore not be required to submit to so tiresome an exercise. And by the way, HBOS was then seen by its regulator as one of the more cooperative firms to deal with. One can barely imagine how the others might have been behaving in a world that now appears to have been stark staring mad. Yet all these well-documented events are now called into question as historical revisionism begins to rewrite the crisis with alternative facts. My own involvement with post-crisis regulation goes back to my membership of the Independent Commission on Banking, chaired by Sir John Vickers, in 2010-11. As a result, I've either observed or participated in most of these reforms, and I must be, if regulation has gone too far, one of those most grievously at fault. I should perhaps remind you that there were and still are a number of influential voices calling for much higher capital in the banking system than is now required, or indeed an end to fractional reserve banking altogether. Sir John himself has repeatedly questioned the FPC's approach to one of the capital buffers, which we have set at what he considers far too low a level. Both the construction of the post-crisis bank capital stack and its calibration are matters on which people of goodwill can and do disagree. But post-crisis regulation, of course, goes far beyond the capital stack. We've added liquidity regulation, overhauled risk weights, introduced increasingly thorough and systematic stress tests. The results of the UK's 2017 stress tests, there are two, will be published in a matter of weeks. We've added a simple, well, fairly simple, gross leverage ratio alongside the risk-weighted system, and greatly increased the credibility and heft of the resolution regime by making it possible to bail in debt holders. In the UK, the credibility of resolution for large firms is being further enhanced by the introduction of ring fencing, which should allow the resolution authority to pluck out the essential elements of a failing bank. And it will certainly end the pre-crisis scandal that free taxpayer insurance by means of an implicit sovereign backstop for retail banks also covered investment bank risk-taking. The Bank of England has also entirely overhauled its sterling monetary framework, both clarifying and greatly liberalising the terms on which banks can access the central bank's balance sheet. During the crisis, one often heard the view, and it's strongly held by some distinguished commentators today, that in 2007 to 8, the system faced only a problem of liquidity, not of solvency. My own time as a banker in the 1990s taught me two crude lessons relating to this point, one theoretical, the other practical. The theoretical lesson is that many banks, on a strict mark-to-market of the illiquid assets in their banking books, are more or less insolvent in bad times, and one does well to bear this in mind. The practical lesson is that the reason a troubled bank cannot raise liquidity in the market is that other banks perceive it as insolvent. The liquidity solvency argument concerns what I believe to be a distinction without a difference in a financial crisis. Now, the FPC, in addition to recommending a UK leverage ratio and establishing a framework to capitalise domestically important banks, has also tackled the calibration of the capital framework. The how much question lies at the core of achieving safety without overreach. Little wonder it's also at the centre of the public debate. Answering it, therefore, requires us to be even-handed in assessing how the wider regulatory framework lightens the burden of the capital framework. I spoke earlier of the credibility of the resolution regime. It's not just economic agents in general, bank customers or counterparties, who need to be persuaded that resolution will work. It's also the members of the FPC. If we did not believe either that resolution could be accomplished or that the combination of structural reform and beefed up supervision provided some protection, we should feel the need to impose much higher capital requirements, something of the order of 500 basis points of Tier 1 capital as a percentage of risk-weighted assets on the banking system. Those who consider the present system onerous should reflect on this point. I believe there's already evidence that a credible threat of resolution is proving to be an important source of discipline on risk-taking behaviour on the one hand, and also the recent recapitalisation of the cooperative bank may be instructive here. Let me take the opportunity to attack the canard, as Robespierre might have called it, that bank capital consists of dead money set aside that banks are required to hold. I'm sure no one present this evening would fall for this, but the view is surprisingly widespread. I mean, rather than saying that banks hold capital, it would be truer to say that capital holds banks. Equity capital, of course, is a source of funding for the institution, a live liability, not a dead asset, and the more there is of it, the cheaper each unit of it should turn out to be. Let me now turn to public accountability. Criticism of the committee takes various forms. Some would like to get rid of us altogether. Brian Griffiths, in his May's lecture earlier this year, for example, called for the FPC to be abolished, as the original Committee of Public Safety was in 1795. He didn't mention executions. He was particularly concerned by two supposed elements of Jacobin overstretch. First, the FPC was supposed to prevent another financial crisis. This was an impossible task, so the FPC would fail, and its failure would undermine by association the credibility of the Bank of England's price stability mandate. Second, the policy tools used by the FPC, especially those bearing on the housing market, were too politically sensitive to be wielded by an unelected body. In other words, mine not his, the committee could neither keep the public safe nor be trusted with the powers that had been granted to it. Now, on the first of these points, my response to Lord Griffiths is to reject his counsel of despair. We may not be able to avoid crises, but we certainly ought to be able to prevent the financial system from amplifying a crisis, as it did in 2008. An ideally structured financial system would actually dampen crises. On the second, his objection to interventions in the housing market is that they create winners and losers. So, of course, do movements in interest rates, as Lord Griffiths acknowledges, but he regards these as accepted. Well, it's the FPC's responsibility to act in such a way as to ensure that anything it may undertake in regard to housing, a sector that, after all, has been at the very centre of financial instability throughout recent British history, is equally accepted by Parliament and public. It might surprise some observers of the committee to learn how much time we spend asking ourselves whether, in any given situation, we have the right to intervene between willing borrowers and willing lenders. Now, the modest interventions we made in 2014 and then again this year to prevent the mortgage and consumer credit markets overheating were technical in nature and operated through the banking system. The public seems to have noticed, though, that the bank had actually done something, even if they weren't quite sure what it had done. It had acted rather than simply lecturing people on the dangers lurking in the housing or credit card markets. Comment on both occasions was overwhelmingly favourable. That, of course, will not always be the case. But believe me, the FPC is well aware of the importance of the consent the public it serves. And this includes giving due credit to the importance of the financial system lending to the real economy. In fact, our aim is exactly to ensure that the system can continue to lend instead of seizing up in a crisis. Regulatory tightening after the crisis, an overdue correction of the frankly negligent status quo ante, has naturally attracted the charge that it was pro-cyclical, potentially restricting credit supply at a time of economic weakness. Tim, in his recent book on money in the Great Recession, expresses the view that the tightening of capital requirements exacerbated the crisis. And Adair Turner has eloquently made a similar point in his review of what went wrong. Banks' internal models, which to some extent drive their capital requirements, have a tendency, not unlike bankers themselves, to jump from complacency about risk to full-blown hysteria. Where models were not used to assess risk, ratings were, and no one has yet accused the rating agencies of having had a good war. Margin calls on derivatives happened at precisely the moment when there was no money. Now, the Bank of England has, I think, shown itself sensitive to credit supply issues in the last few years through its sponsorship of the Funding for Lending scheme, and then after the EU referendum, the Term Funding scheme. And of course, the early launch of quantitative easing, right in the teeth of the crisis, prevented a severe monetary contraction. The combination of looser monetary policy and tighter macroprudential policy, far from being incoherent and contradictory, as it has appeared to some observers, has turned out, I think, to provide a mutually reinforcing setting at what is rather an unusual juncture. I leave to more learned commentators the interesting and important question of the extent to which the use of active macroprudential policy has allowed or required interest rates to remain lower for longer than they might otherwise have been. Rightly or wrongly, it's the potential throttling of credit to businesses that most tends to preoccupy policymakers. The FPC has spent a lot of time on this because it worries us too, and credit supply to small businesses was certainly very constrained in the immediate aftermath of the crisis. In my view, widespread risk aversion by both borrowers and lenders played a much bigger role here than regulatory changes, if only because small business loans account for such a tiny proportion of bank balance sheets that they're not especially sensitive to shifts in the capital regime. Large businesses generally fund themselves outside the banking system. It's hard, after all, for a bank to make money on intermediation with a client that enjoys a better credit rating than it does. The majority of lending to non-financial companies in Britain concerns either real estate investment or de-equitization, the process by which a conservative corporate balance sheet is geared up until it is conservative no more. Commentary on bank lending to businesses, or its absence, frequently relates to an idealized model of the banking business that's probably something like 40 years out of date. Although we may disagree on the extent to which regulation after the crisis had pro-cyclical effects, we can certainly agree that such effects are undesirable. The FPC has criticised regulations and practices on the grounds of pro-cyclicality, and it's actively deploying, and this is certainly an ambitious aspect of the new regime, the countercyclical capital buffer, or CCYB. The objective is to absorb shocks rather than amplify them. Now, if we've built the buffer in good times, and we're building it at the moment, we can release it as and when risks crystallize. The really bold design feature here is that the CCYB release is designed to override the instinct of a micro-prudential regulator and to prevent capital requirements standing in the way of banks providing the real economy with finance during a crisis. We've said that in normal times we expect the CCYB to be around 1%. We've indicated that we expect to raise it to 1% at our meeting this quarter. Now, in principle, there's no limit to its size. You doubtless have seen a significantly higher number in 2006 had the CCYB existed then. Back testing suggests a number as high as 500 or 600 basis points. We have some experience with using it. We first increased it from the zero setting in early 2016 and then released it after the EU referendum to encourage the continued provision of credit at a time of high uncertainty. And now, by raising the buffer gradually, we hope to reduce the need for banks to tighten credit conditions in order to comply with it. We are very conscious, believe me, of the uncertainty inherent in assessing a concept as nebulous as the overall risk environment. Gradualism should help avoid both negligence and the raising of expensive false alarms. It's only in hindsight that countercyclical policy looks easy. But it lies at the heart of macroprudential policy. And I'm aware that some in this audience may be concerned more generally about the potential macroeconomic consequences of structurally tighter bank regulation. And the clearest message from the banking markets immediately after the crisis was that undercapitalized banks did not lend. It was the strong institutions, think of Wells Fargo or the Canadian banks, which kept credit going. Alongside the supervisory imposition of gradual increases in capital requirements, funding pressures in the open market ruthlessly distinguished between institutions. Once the possibility of failure had become a reality, the market itself imposed higher capital norms. Outside of crises, the macroeconomic impact of capital regulation has two aspects. The required level of capital in steady state. Steady state, of course, is a configuration of affairs decidedly more often evoked than actually observed, and the transition to this level. The FPC's judgment is that the gross burden of higher capital requirements on banks' funding costs is very low, in the single-digit basis points. That said, one has to get to the steady state. And during such a transition, one can reasonably expect adjustment costs. If whole business models are fundamentally predicated on excessive leverage, as they were before the crisis, they will have to be cut back. Of course, regulators understand that banks need time to retain earnings, especially when those earnings are cyclically low. That's why the Basel reforms, into which, by the way, the UK ring-fencing rules were slotted, had an 8-year transition period. When the Independent Banking Commission recommended in September 2011 that ring-fencing should be introduced alongside the other Basel reforms at the beginning of 2019, people were incredulous. We were obviously kicking the ball into the long grass. This was never going to happen. Well, it's happening now. And some things take time. That distant rendezvous of January 2019 is suddenly just round the corner. And I frankly believe that we would have risked adverse macroeconomic consequences had we tried to hurry things. Now, since I agreed to give this talk, two of my FPC colleagues, Don Cohen and Alex Brazier, have laid out in speeches which I commend to your attention, but do not intend to recapitulate, the underpinnings, as they see them, of current policy. For me, the crucial point in Don Cohen's speech at Wharton reads as follows. In finance, the private sector, left to its own devices, will never fully price in the consequences of its actions. Society hands out banking licenses and the privileges that go with them. It's then left to deal with the externalities that the industry disregards. After the experience of the financial crisis, we may be excused for prepositioning, so to speak, the clear-up. To put it pithily, regulators are needed to keep banks safe because no one else will. Let's not forget that in the remote pre-regulatory period, bank shareholders had unlimited liability, and directors in some cases faced the death penalty our French predecessors would surely have approved. And now banks complain about the senior managers regime. Moving to the international stage, the criticism to which the construction of the post-crisis capital stack, with its plethora of buffers, is most frequently exposed is that of excessive complexity. Now, while every detail of it can be lovingly defended, I think it's quite difficult to put hand on heart and say that the intricacy of the overall design is both necessary and desirable. But complexity at the margin is a price worth paying for international agreement and a precious, even if not absolute, degree of international consistency, now under some threat. Of course, it's possible to reach bad international agreements, but even moderately good ones can bring disproportionate benefits. This is, of course, a rather unfashionable view at the moment, where powerful people in some countries seem keen on tearing them up. It sometimes feels as though the only international agreements such people approve of are the imaginary ones they've not yet been able to sign. Complexity of all kinds, regulatory and other, weighs most heavily on the smaller firms. For big firms, it probably helps in a perverse kind of way, since it creates barriers to entry, very potent ones. Some of those large firms, no doubt, would happily put up with a system 3 times as complicated if it allowed them to operate with half as much equity and less competition. But we know from recent remarks by Sam Woods that the PRA is keen to simplify the conditions that challenger firms face whenever this is appropriate. Let me conclude by briefly touching on the way in which the FPC operates as a committee. It differs from the Monetary Policy Committee, the familiar, established, and successful body on which its design was modelled, in a number of important respects. It holds fewer policy meetings, 4 routine rounds of meetings a year against the MPC's 8. It considers a wider set of issues and has a broader set of tools with which to handle them. It works in general by addressing directions and recommendations to other bodies rather than by taking unilateral action. Its financial stability objective is frankly vague beside the precision of the inflation target. And financial stability can be defined in various ways in terms, for example, of continuous credit provision, which gets you some of the way there. We all know, though, what financial instability looks like. The FPC has a different cast of mind. While the MPC concentrates on the central path for the economy and likely deviations from it, we're focused on tail risks, an activity which requires peripheral vision. And the FPC reaches the majority of its decisions, so far in its life, actually all of them, by consensus rather than by vote. Now, the requirement to seek consensus is imposed by statute on the chair of the meeting, as a general rule, the governor. This wise legislative stipulation takes into account the variety and complexity of the FPC's decision-making processes. It is rare for the committee to be faced with the kind of binary choice for which voting represents a natural mechanism. Is housing a field in which we should intervene? Is now the time? Which of many available tools at our disposal would be the most appropriate for us to deploy? At what level should that tool be calibrated? This not untypical chain of decisions may require a long period of reflection, consideration, preparation, and debate. That isn't always the case. The committee reacted very swiftly to the referendum result in the summer of 2016 in concert with the MPC to reduce the risk of a credit contraction. But generally, the pulse of decision-making is deliberate, and the committee usually signals before it acts, both in order to observe external feedback on the judgments it expresses and to build market confidence in its reaction function. The downside of consensus is that it may be inseparable from the threat of groupthink. There's something magnificent about the voting rituals of our colleagues on the MPC. The group debates and considers, then the individuals decide. Most of us on the FPC expect that we shall use votes when we reach contested binary choices in, say, the setting of a buffer. But that will be the exception rather than the rule. And in the meantime, the absence of voting may fuel the suspicions of those who see consensus as no more than a Latin word for groupthink. I want to say something about groupthink here because the risk of it has quite reasonably preoccupied some recent members of the Treasury Select Committee, the body through which the FPC, and that very much includes those of us who are external members, is scrutinised. On that scrutiny, the independence of the Bank of England and its policy committees ultimately rests. It matters. So what exactly is this dreaded groupthink? Let me set out two things that I believe it is not. It is not merely unanimous agreement. If it were, the uncontested opinions of successive Treasury committees that groupthink was bad would in themselves be mere groupthink and thus to be deplored. Clearly, it's difficult to accept this subversive conclusion. Unanimity arrived at after vigorous debate is not the problem. For the second thing it is not, let me use plain words, partly because the bank is anxious to communicate clearly, and partly because outsiders sometimes courteously pussyfoot around delicate matters. Groupthink is not the failure of external members to argue with the bank's staff or stand up to the governor because they're too idle, too cowardly, or too thick. Let me assure you that's very much not what goes on, but if it did, it would not be groupthink. It would be spinelessness. I see groupthink as both more subtle and more insidious than either of these rather coarse phenomena. I see it as a condition arising from a network of shared assumptions which are so deeply held by participants that they never surface for question or debate. They're culturally based and culturally biased. They're more or less invisible, and in consequence are extremely hard to spot by members of the group. Groupthink is what goes by default. I fear, though, that many shared assumptions may be closely correlated with the skills, experience, and knowledge required to make someone a useful member of the FPC. A colleague who couldn't follow the debate would be unlikely to spot the fatal flaw. We are all attached to the idea that diversity in its various manifestations provides one form of immunization against this condition. It may, and the FPC could well do with being more diverse. But in the context of groupthink, the type of diversity needed must balance differences in underlying assumptions with shared skills and experience. As an independent external member, I feel a special responsibility to be alert to this, especially since everything we know about the behaviour of committees and of boards points to the difficulty of getting this right. Public debate at present on any number of issues, this is not an original remark, is both more polarised and more raucous than it's been for some time. This may offend the sensitive, but one would hope that the violent circulation of warring ideas might at least inoculate the body politic against groupthink. Unless, of course, we're dealing with rival versions of the truth that are literally unable to communicate with one another. A paradoxical multiplicity of thought systems that each believe themselves to be singular. I think Robespierre and his colleagues would have felt at home here. Can what the French call la pensée unique have plural forms? These dialectical tensions arise in part because it is uncomfortable for human beings to hold competing ideas in their heads for very long. Are banks dangerous beasts that need taming? Or do they provide the lifeblood of the economy and should therefore be left alone? Simplification may sometimes be unrespectable, but it's reliably analgesic. Perhaps the fundamental anti-groupthink challenge for FPC members is never to lose sight of the underlying duality of financial markets and financial institutions. These are capable of unleashing both transformational forces for the benefit of society and destructive forces which can cost it very dearly. Depending on the state of the financial cycle, it's easier to concentrate on one of these at the expense of the other. Regulators certainly made that mistake before the crisis, when the possibility of destruction was more or less overlooked. And we are, as I hope I've shown, conscious at least of the accusation that we may now have gone too far the other way. Metaphor around the FPC tends to the hydraulic. In the committee's earliest years, the fire brigade was always being summoned. Think of us perhaps as a corps of engineers responsible for the height and state of the dams closing off a reservoir and for dredging channels in the floodplain. Everyone needs a reliable water supply, but rainfall is unpredictable, and rivers sometimes burst their banks. I trust the serious and, believe me, unglamorous work of the FPC in looking after a crucial aspect of public safety will endure. The times are turbulent, and a responsible financial system constrained by thoughtful and measured regulation has a huge role to play. As a committee, let us continue to work on being humble in seeking consent from the public and on being bold in providing safety. And no, I don't believe financial regulation has gone too far. No way. But thank you for listening to me.